So, let's talk about Richardson Electronics. On the surface, their latest earnings report looked pretty good, right? Strong revenue, but then their stock absolutely cratered. So, what on earth happened here? In this breakdown, we're going to dig into the numbers and figure out why a great headline sometimes tells, well, a very different story underneath. Let's jump in. And this right here is the central mystery we're trying to solve. You've got a company that beats revenue expectations. Not just that, but they've been growing for 6 straight quarters. So how in the world does that lead to a double-digit stock drop? It feels like it just doesn't add up. But believe me, there's always a reason, and we're going to get to the bottom of it. Okay, just look at these two numbers side by side. It's a bit jarring, isn't it? On one hand, you've got this really solid revenue beat, up almost 5%. That's great. But then you look at the other side and bam, the stock is down nearly 12%. This is a huge clue. It tells you right away that the market, that investors, they were looking straight past that top line number and were laser focused on something else, something they did not like. All right, so let's get into the results and what caused that headline shock. To really crack this case, we have to look beyond that shiny revenue number and dig into the nitty-gritty of the income statement. The real story, as it usually is in the details. And here it is. This is the smoking gun. You see that revenue line? Fantastic. They brought in $52.3 million when the street was only looking for about 50. A solid beat. But then, your eyes drift down to that next line, the earnings per share, or EPS. And oof, the expectation was a small profit, plus 2 cents. Instead, they posted a loss. That's a 3-cent miss, and it completely changes the narrative. And if that wasn't enough, look at the gross margin. It slipped a bit compared to last year. These two things together, that's what sent up massive red flags and really spooked you. So what we've got here is a classic tale of two stories, a real tug of war between growth and profit. You had management on the earnings call talking all about their growth strategy, while Wall Street was basically screaming about the lack of profit. Let's dive into management's side of the argument first. And this is what management wants you to focus on. Look at this growth. Their Green Energy Solutions, or GES, business is up a staggering 39% year over year. That is huge. And their Canvys division, which makes display solutions, is up over 28%. From their perspective, these are the engines of the company. This is the future, and it's growing like a weed. So the message from the C-suite was really clear. Hey, our strategy's working, just give it time. They kept pointing to the evidence. 6 consecutive quarters of sales growth, that's not nothing. They're shifting the whole business into these high-growth areas. They've got a stable backlog of future orders, plenty of cash on hand, and they're promising to keep a lid on costs. They're trying to build this compelling case for long-term value, asking investors to look past the short-term bumps. Right. So management's whole case really boils down to playing the long game. They're telling everyone to focus on their strategic pivot and the big catalyst coming down the pipe, and to view this one quarter's loss as just a temporary blip on the radar. And they weren't just being vague about it either. They laid out a pretty specific roadmap. They're expanding internationally, with shipments already heading to Asia and Europe. Their new battery storage demo center in Illinois, that's set to be finished by the end of the fiscal year. They're also counting on the whole semiconductor market to bounce back in 2026. And they're expecting their Siemens tube repair business to finally start making money early in fiscal 27. So this is their plan to show everyone, see, we told you so. Okay, but as you can imagine, the analysts on the call weren't just buying the future story without asking some tough questions about today. And the Q&A session, well, that's where you could really feel the market's nervousness start to bubble up. One of the big questions was about that backlog for their star player, the Green Energy Solutions segment. You see that insane 39% growth, and the first thing you ask is, okay, that's great, but is the pipeline still full? Is there more where that came from? A small dip in the backlog had people wondering if maybe, just maybe, things were starting to slow down. But management had a pretty solid answer ready to go. They said, look, it's just a timing thing. We had such a massive sales quarter that we shipped a ton of product out the door. They were quick to point out that the backlog for their core products, the real bread and butter of the segment, actually went up. And get this, their book-to-bill on those core products was 1.10. That's a super healthy number. It means for every dollar of product they shipped, they booked $1.10 in new orders. They were basically saying, don't worry, the momentum is still there. Okay, so we've heard both sides of the story. We've seen the numbers. So what does this all mean for the next quarter? Let's pull it all together and give you our take on what to expect. So here's our outlook for the next call. First, for the results themselves. We fully expect to see continued strong revenue growth from both GES and Canvys.
But, and this is the big but, all eyes are going to be on the margins. Profitability is the name of the game now. Second, what does that mean for the stock? We think it's probably going to be stuck in a trading range for a while. This is what we call a classic show me story. The market is basically telling the company, show me the profits, then we'll talk. Until then, don't expect big moves. And third, that leads us to our rating. We're giving Richardson Electronics a market perform. The growth story is absolutely there, it's compelling, but you just can't ignore these profitability issues in the short term.
And really, if you want to boil this whole situation down to one sentence, it's this. You have the market reacting to one bad quarter of profits while management is trying to sell a vision for the next several years. The multi-million-dollar question for anyone looking at this stock is pretty simple. When, or maybe even if, those two very different stories are going to finally line up. And as always, remember, this is not financial advice.